top 5 investment mistakes to avoid and how to fix them. You're young, you're ambitious, and you want to secure a future where money isn't a problem, right? But here's the thing. Mistakes are inevitable, especially when it comes to money. It's like playing a video game. You get a couple of levels in and then, bam, you hit a wall. The real question is, can you avoid that wall, or are you doomed to crash into it? Well, today we're going to make sure you never hit that wall again. I'm about to show you the top 5 investment mistakes that could derail your financial future, and more importantly, how to fix them before it's too late. So stay tuned until the end, because number 5 is a game changer that could save you thousands. Let's face it, making money is hard, but losing it? That's way too easy. You're sitting there binge watching Netflix. Those market trends are moving fast, really fast. So here's the first mistake that many young investors make. Mistake number 1. Every day, millions of new investors try to chase quick profits, whether it's through day trading, crypto hype, or the latest hot stock. Fear of missing out, or FOMO, is real. Here's the problem. While you might make some quick wins, you're also setting yourself up for massive losses. It's like trying to surf in a storm. Sure, you might catch a wave, but most likely you'll wipe out. Fast profits equal fast losses. And let's be honest, nobody wants to be the guy who buys at the peak, only to watch their investment plummet the moment they hit sell. So, what's the fix? Don't try to time the market. Instead, focus on long-term investing. By buying quality companies and holding them, you can ride out the storms and catch those long-term waves of success. The stock market has historically gone up over the long term, even after the worst crashes. So, resist the urge to chase fast gains and play the long game. Mistake number 2. Now imagine putting all your eggs in one basket and then dropping that basket. Ouch! That's what happens when you don't diversify. Many new investors make the mistake of putting all their money into one stock, one sector, or even one asset class. And when that investment takes a dive, so does your entire financial future. Yes, we know, it's tempting to go all in on that next big thing, but that's a rookie mistake. The stock market is unpredictable, and putting all your eggs in one basket is risky. But don't worry, there's an easy fix. Investing is all about spreading out your risk. A diversified portfolio is your best defense against market volatility. By investing in a mix of stocks, bonds, and maybe even real estate or international markets, you reduce the chance of one bad investment sinking your entire strategy. The beauty of diversification is that, while not everything will rise at once, there will always be something that's doing well. Balance is key. Mistake number 3. Here's a mistake that a lot of people overlook. Fees. Investment platforms, advisors, and even certain funds charge fees that can slowly eat away at your profits. You might not see it at first, but over time, those fees can take a huge chunk out of your returns. It's like paying a premium for a haircut, but then finding out they didn't even use scissors. It feels like a ripoff, right? But here's the thing. You need to know what you're paying for. The fix here is simple. Choose low-cost investment options like index funds and ETFs. These funds are passively managed, meaning they follow a broad market index, and usually they come with low fees. If you're paying an advisor, make sure you understand exactly what you're being charged for and whether that service is worth the cost. Every dollar spent on fees is a dollar less in your investment account, and over time that adds up. Mistake number 4. Emotion is the enemy of smart investing. Whether it's fear during a market dip or excitement during a bull run, letting your emotions drive your decisions can cost you big time. We've all seen it. That moment when your stock crashes and suddenly you're ready to sell everything. Or maybe you're so hyped by a hot stock that you buy in too late. Both lead to disastrous outcomes. Calm down, it's not the end of the world. If you're investing emotionally, you're setting yourself up to lose. So what's the fix? Set a strategy and stick to it. If you've done your research, know your risk tolerance, and have a diversified portfolio, don't let short-term market fluctuations dictate your actions. Remember, the stock market doesn't care about your feelings. So, take a deep breath and trust the process. Mistake number 5, and finally, this one is the most powerful, yet most ignored mistake of all. Not understanding the power of compounding. You've heard the phrase, the early bird gets the worm. Well, in investing, it's the early investor who gets the wealth. Compounding is where the magic happens. It's your money making money, and then that money making even more money. The earlier you start, the more time your money has to grow. But if you wait too long, you miss out on years of potential growth. That's why every day you delay is a missed opportunity. Imagine if you could look back 10 years from now and say, I started early, and now my money's working for me. The power of compounding is huge, and it's something you can't afford to ignore. But if you want to dive deeper into how compounding works and how to harness it for maximum returns, check out my next video on how compounding can change your financial future. Trust me, it's going to blow your mind. Don't miss it. End screen with video recommendations and a CTA to watch the next video. Stay smart, stay patient, and keep investing in your future.